If you open a standard brokerage account today, the default behavior is simple. Buy the S&P 500 and ride the upward momentum of major tech corporations. This chart reveals a mathematical anomaly beneath that equity boom. Throughout 2025, as the broader market accelerated, U.S. real estate investment trust valuations flatlined. You'd have to look back to the 2008 financial crisis, or 2020, to find a valuation gap this severe. An everyday investor looks at that flatline and assumes the commercial real estate sector is failing, misinterpreting the actual economic reality. But the company ledgers reveal a disconnect. The operational fundamentals of these real estate portfolios didn't crash alongside their stock prices. They grew. This chart shows the internal health of the sector between 2024 and 2025. Aggregate funds from operations increased by 6.2%, and total dividends paid out to shareholders climbed by 6.3%. While retail traders flee the perceived flatline, institutional buyers are stepping in. Today, over 70% of major U.S. pension funds integrate these real estate assets into their strategies. These multi-billion-dollar funds see a structural, mechanical advantage in the data that the tech-obsessed retail market has overlooked. A real estate investment trust, or REIT, is a company that owns, operates, or finances income-producing commercial properties. That includes everything from apartment communities and regional malls to medical facilities and data centers. Congress created the legal framework for these entities in 1960. The goal was to give the investing public a way to access large-scale commercial real estate without needing to buy a skyscraper outright. To maintain their specialized tax status, these trusts must follow a strict rule. They are legally mandated to distribute at least 90% of their taxable income directly back to their shareholders. Because they derive their revenue from long-term tenant leases, that strict dividend mandate translates into a transparent, predictable stream of income. This legal structure forces REITs to act as consistent, cash-generating engines, functioning on a logic distinct from speculative growth stocks that rarely pay dividends. Buying a physical commercial building takes months of paperwork. REIT shares, however, trade on major stock exchanges with instant liquidity. You can even purchase the entire sector at once. Passive vehicles like the SPDR S&P U.S. Real Estate Select Sector ETF allow investors to buy a bundled stake in these properties. That liquidity allows investors to move beyond the physical concrete and apply a concept known as the efficient frontier. This scatterplot, based on historical Ibbotson Associates data, shows that adding REITs to a standard stock and bond portfolio pushes the efficient frontier upward. It generates higher returns for the same level of risk. This shift is driven by the fact that real estate has a historically low correlation to other traditional equities. When other sectors dip, commercial rent checks continue to clear. Institutional investors employ these assets as a mechanical counterbalance, using the yield to structurally stabilize their portfolios against market volatility. When stock prices decouple from positive operating metrics, the resulting gap creates a pressure point for a market correction. Investors eventually rotate back toward the undervalued yields of the underlying real estate. But waiting for the U.S. market to adjust is not the only strategy. There is a massive performance discrepancy playing out right now on a global scale. This map illustrates the stark geographical divide. By late 2025, the U.S. real estate index had returned 4.5%. Meanwhile, Europe hit 19.9%, and the Asian index surged to 28%. International real estate markets operate on different economic cycles than the United States. Actively managed global REIT funds leverage those staggered cycles to capture growth wherever it peaks. Maintaining a US-only mindset in a volatile market blinds investors to the yields occurring globally. We are looking at a financial vehicle backed by tangible assets, driven by a forced dividend yield, and armed with public market liquidity. It swaps the speculative anxiety of chasing the next tech boom for the structural reliability of commercial real estate. You can look past the current market noise and adopt the same completion strategies used by the largest pension plans. You don't need billions of dollars to invest like a sovereign wealth fund. Over the last 2 years, a massive divide opened up in the stock market. While investors flooded AI-linked tech stocks with capital, real estate investment trusts were largely left behind, trading at significant discounts to the broader equities market. Despite these lagging stock prices, the underlying businesses remained resilient. Throughout 2025, REIT fundamentals like funds from operations and total dividends grew by more than 6%, showing that property cash flows were normalizing, even as valuations stayed suppressed. That valuation gap is now beginning to narrow. The primary driver is a shift at the Federal Reserve, which has moved toward a measured path of lowering interest rates. Falling rates provide a dual tailwind for commercial real estate. They lower the cost of debt for acquisitions and development, while making the high dividend yields offered by REITs far more attractive than the returns found in fixed income bonds. Capturing this shift requires precision. Rather than tracking a broad domestic index, institutional experts rely on a specific structural playbook to isolate the highest quality growth. This strategy is known as portfolio completion. Today, over 75% of major U.S. pension funds with assets exceeding $25 billion use liquid public REITs specifically to fix structural flaws in their private real estate holdings. Private real estate is notoriously illiquid, and scaling up a direct property allocation can take years. Public REITs offer an immediate alternative, providing institutional-grade exposure that can be sized and traded instantly to balance a portfolio's weightings. These institutions use REITs to target sectors with intense structural demand, specifically data centers, which power the expansion of cloud computing, and senior housing, which is supported by a rapidly aging baby boomer demographic. The results are measurable. Portfolios that use REITs for completion have historically and consistently outperformed standard private-only real estate strategies through multiple market cycles. However, even a perfectly balanced domestic portfolio has a limit. In 2026, staying strictly within U.S. borders means ignoring the regions where the highest yields are actually being generated. This reveals a critical blind spot. Many investors assume a domestic U.S. REIT allocation represents the full scope of the real estate market. The data from 2025 tells a different story. While the U.S. market is a massive component of global real estate, domestic equity REITs delivered a relatively muted return of 4.5%. During that same period, the European real estate market surged. Despite localized economic headwinds, it generated returns of nearly 20%. Asia saw even more dramatic decoupling. Asian real estate markets yielded 28%, completely outstripping the performance of domestic U.S. allocations. Global real estate markets do not move in unison. They are driven by unsynchronized interest rate cycles, currency fluctuations, and varying regional trade policies. Because these markets operate on different schedules, achieving a truly complete portfolio in 2026 requires looking beyond a single geography. This global requirement is made even more urgent by the impending political pressure on interest rates here in the U.S. The Federal Reserve currently favors a path of caution, attempting to lower rates slowly to ensure inflation remains under control. That slow and steady approach faces a major challenge in May 2026. The Fed chair's term expires, just as the presidential administration is pushing for aggressive rate cuts to below 1%. This impending rate drop forces a race for yield. Investors are moving to lock in high-yielding domestic triple net lease rates now, before a sudden rate cut sends valuations soaring and compresses those yields. Navigating 2026 requires balancing this domestic volatility against the stability and outsized international yields. Success in the coming year depends on a dual mandate: structural completion of the portfolio at home and geographic expansion abroad. Home country bias is an expensive risk. By failing to look overseas to hubs like London, investors miss out on cyclical recoveries happening elsewhere. Publicly traded REITs remain the most efficient tool for this expansion, providing immediate exposure to international markets without the complexity of direct foreign property ownership. Sovereign wealth funds and the world's largest institutional managers are already executing this completion to expansion pipeline. It is the measurable playbook they use to maintain performance in a high volatility environment. To capitalize on the great real estate disconnect, you must look beyond borders. Use REITs to plug gaps, then expand to find yield. Thanks for watching. Subscribe to stay updated on the strategies smart money uses